This episode is brought to you by Audi. The road is calling. Embrace the thrill of the drive with the all-new, fully electric Audi Q6 e-tron. Featuring effortless power, serious acceleration, and advanced Audi tech. It's not just a new EV, it's a new way to experience driving. The all-new, fully electric Audi Q6 e-tron is here. The next chapter of Audi starts now.
Ryan Reynolds here from Mint Mobile with a message for everyone paying big wireless way too much. Please, for the love of everything good in this world, stop. With Mint, you can get premium wireless for just $15 a month. Of course, if you enjoy overpaying, no judgments, but that's weird. Okay, one judgment. Anyway, give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. Intro rate first 3 months only, then full price plan options available. Taxes and fees extra. See full terms at mintmobile.com.
Welcome back to The Bull, your personal finance podcast. It's not easy to choose the right tone or topics for the episode of this podcast in times like this, especially now that you know who, Lord Donald J. Voldemort Trump, has returned, and with his Death Eaters, J.D. Vance, Scott Bessent, and Howard Lutnick, is wreaking havoc on global markets. One of our hopes, of course, is that, for example, Treasury Secretary Scott Bessent will turn out to be this story's Severus Snape, that he's actually been on the good side all along, and that, thanks to him, the Dark Lord of Tariffs will eventually be defeated. In the meantime, we are taking things one day at a time, because at this point, even a minus 5% in a day on Wall Street doesn't really qualify as news anymore. So I have two options now. I could bug you every 3 days talking about Trump and tariffs and Trump. How dull, how boring. Or, since this podcast is built on patience, composure, consistency, and a long-term mindset, we could stick to our principles and remind ourselves of one key thing. Investment principles matter more than individual historical events, no matter how extraordinary they seem. Sensible investing, that's what this podcast has always been about, is what keeps us from losing our way during chaotic times like these. Investing in ETFs when markets are only going up, that's easy. But if it were always that easy, why should stocks return 7, 8, 10% per year on average? It takes the minus 20%, 30%, 40% and maybe worse to separate true investors from pretenders and to truly earn the risk premium. With that spirit, over the next few weeks, we'll continue to comment on the main twists and turns of this grotesque tariff saga, hoping it ends up more comedy than tragedy, but always giving priority to what really matters, how to best invest our own money. US presidents come and go, and if there's a silver lining in this bloodbath of a market, it's this: our portfolio will outlive the current occupant of the White House. So taking care of its long-term health is far more important than what happens during these months of apparent madness. In the grand scheme of long-term investing, even this brutal April will one day be just another bloody month in the rearview mirror. With that said, it's a real pleasure today to share an interview I recorded 3 weeks ago with one of my absolute favorite financial journalists, Robin Wigglesworth, widely read columnist at the Financial Times and editor of Alphaville, the Financial Times Finance and Investment section. Of course, this whole post-April 2nd chaos wasn't even remotely on the radar at the time of our chat, though, as you'll hear at the end of the episode, Robin already had a sense that something unpleasant might be brewing. And when asked how to face the markets in the presence of such a supervillain, well, I'll let you hear for yourself his funny and perfectly on-point answer, which is more important than ever in a moment of panic like this. Without further ado, here's my conversation with Robin Wigglesworth. Enjoy the episode. Dear Robin, welcome to my podcast, The Bull.
Hi, Riccardo. Thanks for having me on. It's a real pleasure.
I'm excited to have you here. I love Alphaville, and in my podcast, we always talk about the contents you address there. Let's start with a very particular story, because we have one thing in common. We both interviewed Gene Fama. And though I didn't have the opportunity to share a lunch with him in Chicago, it was enough for me to interview him at 1 a.m. in the night here in Milan because he was in California in December. We covered his main topics like efficient market hypothesis, factor investing, and so on and so forth. And obviously, I asked him what he thought about the market becoming less efficient over time, as some, like his former student Cliff Asness, for example, have been telling in recent times. His idea is nothing has fundamentally changed. He sees no evidence that markets are broken or something like that. What is your idea? Because we saw a lot of craziness in the last years, and it's hard to believe markets are perfectly efficient.
No, I think, quite a lot of people maybe focus too much on the word efficient or efficiency.
Yeah, right. Yeah.
When I spoke to Gene as well, it was something we talked a lot about, and even he admitted that maybe it's the wrong word for what he's trying to describe, but I think it works as a shorthand. But his view is that markets are constantly baking in the assumptions, the prejudices, the hopes, the analyses of millions of people, ideally. And that doesn't mean that prices are always right, per se, but that they are as right as we can. They synthesize, basically, the hive mind of everybody around the world. And, people have a lot of incentives to do well, right? So if you can consistently predict that markets are wrong somehow, then you should be a multi-billionaire or multi-trillionaire. So his view is that the best way of describing this is that the markets are efficient, that they work, basically. For me, I don't think markets are efficient in any sort of sense of how we understand that word, because yes, we see stupid shit happen all the time, every day in every market. The thing is, we've seen stupid shit happen everywhere throughout history. I mean, we feel this time is particularly unique, but there have been sort of technology bubbles before. There have been, big bear markets. There's been stupid things happening all the time. For me, I think my preferred word for what Barmer's suggesting, I'm saying this with all humbleness, is the fair markets hypothesis. That prices are fair compared to everything we happen to know. And maybe they're wrong. Maybe the markets are inefficient, but they're roughly fair. Because it should synthesize what everybody thinks. If you think they're unfair, if they're too low, then you can buy that stock and it'll go up. And if you think it's too expensive, you can short it. But over time, I think the market prices are fair given the prevailing sort of macroeconomic conditions, the outlook for corporate earnings, and just general greed and fear, and the kind of the cycles in human psychology.
Yeah, totally. Actually, if prices were obviously wrong, then you should be rich.
Yeah. Yes, no, that's how Gene Fama says it. If they're obviously wrong, then why aren't you sitting on your own private island somewhere in the Caribbean?
The efficient market hypothesis, along with other milestones in the 60s like the CAPM and Markovitz's efficient frontier and modern portfolio theory, laid the ground for what it's called the passive investing revolution or systematic investing revolution, whatever you want to call it. Gene Fama told us, never try to pick the winning stocks, just buy the market and everything's going to be okay, or sort of. You wrote a remarkable book titled Trillions about the birth of index funds, which is, by the way, highly recommended. In your opinion, What is the case today for passive investing?
Well, it's very kind of you to say. I mean, it was a labor of love writing this book, and not everybody loves index funds or passive investing, but I want to kind of tell a story of like how investment has evolved over the past century, really, but with some of the index fund as the humble hero in the middle. And what's ironic is that the case for passive investing is as strong today, if not stronger than it ever was before, and it remains the same. For the vast majority of people, you will actually do better than average by just trying to be average, by buying the entire market. And you can do so cheaply. There are various theories behind it, the various empirical facts behind it, but we do know that over the long run, in almost every single market, whether it's US stocks especially, which are very efficient or very fairly priced, very hard to make above market gains there, or even markets that people have always thought of being some more fertile terrain for investors, like the corporate bond market, emerging market bonds, things like that. In practice, in the long run, the vast majority of active managers underperform the market as a whole, both before but especially after fees. So some people do better before the fees, but they charge so much money for doing so that, the investor loses out anyway. You'd be better off just trying to find the cheapest possible broad exposure and just sticking to that. I mean, there's a reason why all the top hedge funds in the world, the people that can plausibly and have plausibly outperformed the market for a long time, they're all closed. This isn't easy. There isn't infinite capacity there. So whenever somebody tells you that they can, and I'm sure they'll show you some big sexy chart showing that they have beaten it in the long run, there are a lot of questions you should ask. Like, for example, show me the charts of all your competitors who are telling me exactly the same thing, but they're no longer in business, maybe, because they underperformed, they lost money over some 10-year period.
Yeah, sure. This story is highly compelling, and I love this idea of the arithmetic of active management, to quote William Sharpe's famous paper. It's close to impossible to consistently outperform the market. And especially for those who need an asset manager, you would need to identify an outperformer in advance. I read somewhere, I don't remember, maybe it was Michael Mauboussin, who did the math and said that it takes 64 years to claim that a mutual fund outperformance is due to skills with statistical significance and not to random luck. So it's crazy to think to beat the market by identifying in advance a future winner.
That's true. I mean, you can imagine the arithmetic of active management is slightly faulty in that, obviously, because the market itself changes. So because of that, it's in theory possible for active managers to beat the market in the long run. And also because active managers are actually only a subset. Like, what do we mean? The market as a whole, like every winner has to have a loser. But like a majority of active managers can beat, because the active managers are probably only a third of the market anyway. But in practice, we see that the vast majority of active managers underperform. And even the ones that outperform, we don't really know whether that was luck or skill. Like you say, some of this stuff, like proving something to a significant degree, takes a long time. And obviously, every fund manager that has done well thinks it's because of their own God-given genius. And everybody who's done badly thinks it's because of somebody else's fault. It's because of central banks or passive investing, ruining markets or whatever. But that's how we're wired as humans. Successes are our own and failures is always somebody else's fault. And that doesn't mean that fund managers don't do a valuable job. I mean, there's a value, societal value, in trying to kind of pick stocks and pick bonds. And, that's actually what makes markets efficient. I just think they maybe charge too much doing so. They're hardworking, smart, credible people. I was joking. Some of my best friends are fund managers. But as an industry, it's probably too big and pays itself too well. And does overall a bad job for the vast majority of investors.
Yeah, sure. And then the bad guy came along. As I told you, we had here a couple of months ago the most prominent critic about passive investing, who's Michael Green. And I told him, "You are the bad guy, Michael." And he told me, "I'm happy to be the bad guy because, as I tell my kids, I know I'm doing the right thing by being the bad guy. As you know, David Einhorn, Michael Burry, etc., a lot of people that made a lot of money by spotting bubbles in the past now think that passive investing can distort the market and make it less efficient by making prices less elastic, by increasing volatility, and so on and so forth. You wrote a lot about it, and I love if you could address the topic because I scared all my audience when Mike came here. Therefore, I really appreciate what you have to say about it.
Well, I would say, look, I love Mike because he's actually one of the more thoughtful critics.
Totally.
For 50 years, the criticism of passive investing was just comically bad and self-serving. These were active managers saying, oh no, this can't possibly work and nobody can be, by average. I mean, the arguments change, but like the reasons stay the same. Basically, they don't like it because obviously it's eating their lunch and their dinner and their afternoon tea.
Passive investing, it's like Marxism.
Yeah, no, it's like that famous quote, like a man can't understand something he's paid not to understand it. And, for most active managers, this is not something they like. So, we've seen arguments against passive being around, frankly, from before they were born. People have argued that the very idea is insane, it's ludicrous. And in reality, even today, most of the arguments I see about passive investing are still comically bad. Look, I talk to people and I read reports on this, and sometimes they just get the basic stuff wrong. Mike and a growing group of more smart and more sophisticated critics, they do the work. They look at this stuff. My view is still that they are either wrong or massively overdoing the argument or failing to recognize or focusing too much on the trees for the wood. The problem is, fundamentally, look, if you want to find proof that passive investing is terrible or bad or does something, you can prove it quantitatively because, frankly, you give a sophisticated data scientist enough time with a big enough data set, you can find what you want. Like, this is the publish or die issue in academia. I have seen academic research by pedigreed, well-known financial economists arguing that passive investing makes markets more efficient and less efficient, that they make stocks more volatile and less volatile. You can essentially find an academic paper that will prove whatever you happen to want. And right now, this kind of inelastic markets theory is quite sort of the hot one. Look, I'm not equipped to deal with mathematics, but I can deal with the basics of prima facie evidence that we have and see just the common sense look of it. That, like, the idea that somehow the elasticity or the ability to stocks to absorb flows, inflows and outflows because of basically the rising amount held by passive funds is in theory interesting, but in practice, I just think it crumbles. What has been driving big tech stocks, for example, higher, is not passive investing. It's the fact that active managers have been buying stocks of companies who've been churning out money for a decade. If you look at the kind of basically where the earnings have been growing in the markets, then, it's a technology. And you see this happen all the time. The markets, when Facebook has a bad quarter, it craps out. It doesn't matter that index funds hold it or not. Markets are more pro-cyclical, but that is far more likely to be because of, the rise of derivatives, single-day options trading, massive multi-manager hedge funds with tons of leverage trading individual quarters. So I just think that, focus on passive, it just feels... It's like you have T-Rexes stumbling around the prairie and you're blaming the cows for altering the environment. It's like, it's probably the T-Rexes are doing the kind of tearing up the landscape. It's not the little cows. And I think, look, this might change. I do, too many people in this world pick a side and stick to it as if it's religion or a football team. Like, if you support Juventus, I have to hate them because I support Milan or whatever, right? And markets shouldn't be that way. So I do try to read all the research around this, and there is more research coming out on passive investing and how it's affecting things. My broad sense is that it is affecting individual stocks at certain times, like index rebalancing, like what stocks go in and out of indices. That does matter. Like these things do matter. And there's more money tracks indices, either through derivatives, index funds, or frankly, active funds that quite often track indices closely anyway. Indices are becoming more important, and the inclusions and exclusions. You can also see certain things with smaller niche ETFs in very specific sectors will sometimes have an impact on those specific sectors in certain times. But for me, that is no different than, frankly, mutual funds or hedge funds have an impact on the markets they trade all the time. And do we say that's evil or bad or makes markets less efficient? Well, no. It's just the whole idea would be ludicrous. A market is a sum of all sorts of difference of animals and actors playing out of play together. And passive is just like one of the actors. And they're mostly, they're kind of the technical jargon phrase that they are price takers. They're not price makers. They just accept the prices set by active managers. And sometimes that's dumb and sometimes that's smart, but we don't really know before, as Gene Farn pointed out. But on a macro level, is the efficiency of the stock market or financial markets as a whole eroding because of this? I think the evidence is frankly non-existent. The theory is interesting, but still to me very uncompelling.
So you're not concerned about the end of the world brought about the growth of passive investing?
No. Look, one of the things that Mike will talk a lot about, that, as more and more money goes into index funds, because it's set on autopilot, there's all sorts of regulatory and personal finance incentives to put money to passive funds, because frankly, we know they do better. So that's that's the default option. And as more money goes into these funds, they buy more and more of the stock market. If there is a major crash, there are fewer active managers around to absorb the selling pressures that might come if all passive funds have to sell. And look, for me, this is kind of ludicrous because, yes, if, let's say there's $30 trillion worth of funds in passive funds now, and $10 trillion worth of that has to sell, yeah, the market's gonna crash. It's gonna crash really hard and fast. But that is exactly the same case if all that money had been in active funds and index funds had not existed. Imagine a marketplace where index funds did not exist and suddenly people yanked trillions of dollars out of the market. The market would still crash. Because frankly, in those kind of moments, we know active managers aren't playing the heroes. They're not saying, no, I will prop up prices. No, they're running out the exit quicker than everybody else. And we've seen this in every single major crisis since the birth of index funds. Active funds sell more aggressively, harder, and do worse as a result than passive funds, where investors tend to stick around a bit more. They kind of know that, this is one of my favorite examples, is that people don't pull money out of a fund when it does what it says on the ticket. With an index fund, if the market drops 20%, the fund is going to be down 20% if it's done its job right. And look, that's not fun, that sucks, but you know that happens. That's just one of those things. Maybe you'll have to sell a bit because you lost your job or whatever. But I think we as humans are okay. We're equipped to deal with bad news when we've been warned about it beforehand. What you really hate is when you have an active fund who's told you that, I'm going to protect you against the big downturns. Unlike passive funds, they're stupid. They just ride all the downdrafts. So I'm going to protect you. If the market's down 20%, I'm going to be down 10%. And lo and behold, active funds on average do even worse than passive funds than they normally do in big downturns. So what sucks is when this fund that said it was going to be down 10%, the market's down 20%, and it is down 30%, that's when you get the hell out. And that's what we've seen in every single major financial setback since the 70s. In the 1974 bear market, in the great crash of 87, in the dot-com bubble bursting, we saw it in the financial crisis, money gush out of active funds because they, on average, did even worse than they did before. And passive funds kept attracting money. Maybe at some point that changes, maybe. But I think I prefer to stick to the areas where we have actual data to rest on rather than make some glib forecasts for the future.
Yeah, sure. I feel that some behaviors are everlasting and matter much more indeed. In this period, I've been reading a lot of articles from 2000 because on March the 10th, 2000, the dot-com bubble started officially to burst. And the things are incredibly similar to that period. People piling into the hot stocks, into the hot instruments, into the most successful active funds that invested at that time in the Nasdaq 100, etc. And then people get scared for whatever reason and sell altogether, because when you see your neighbor losing money, you don't want to be the one left over. So if these things happen all the time, I believe that the instrument you're using to invest is not that relevant after all. I believe behaviors matter much more. What do you think about it?
Yeah, I mean, the index fund, whether an ETF or an index mutual fund, is just a really good technology that's been around for 50 years to get broad, cheap exposure to financial markets. And when you look at it that way, it's like the idea that people blame the tool above the activity. Look, if markets are bubbly or people get overexcited, whether it's AI or the internet stocks, or, back in the 60s, it was IBM and Xerox were the hot growth stocks. The markets bubble up and people do stupid things. And, these, like you point out, like the behavior on a macro level doesn't really change that much. We're still fundamentally wired as humans. And everything we've seen today, we've seen variants of in the past. It just kind of reiterates itself with a different flavor as the world changes alongside it.
One of the things that index investing made clear to the world was that most of the time, simplicity beats complexity. You live in Norway, and Norway has a very interesting case study with the sovereign fund, managing an incredible amount of money, more than most of the country's GDPs in the world. Here in Italy, we read a lot of articles about how great they were to manage it and to make the fund grow that much over time. I then looked at the asset allocation, and it turns out it is basically a market cap weighted 70% stocks, 30% bonds. So the most basic stuff you can do with a couple of index funds or ETFs, even with one ETF from Vanguard if you buy the Life Strategy ETFs. Why do a lot of institutional investors struggle, in your opinion, to seek very complex instruments while something very simple and straightforward works better than anything else most of the time?
That's a great question. I think, look, there are many areas in human history and behavior where, like, the data is very clear about we should do X and we as humans keep doing Y. Despite that, we know it's wrong or stupid. We still eat chocolate and drink too much and, do bad things, even though we know it's going to cut into our lifespan. So I guess, like, there are different aspects to it. So one thing is just human. That, like, still to this day, the idea that you can do better than average by just trying to be average is weird, right? We're hardwired as humans. We want the best doctors, the best dentists, the best teachers, the best cars, the best food, the best TV. The idea of buying something that just tries to be average is designed algorithmically to be average, and then that will get you better results over time, is counterintuitive. It's why, frankly, always, active management has always had the best marketing, whilst passive investing has always had the best data. Like, the data is very, very abundantly clear, and we've had like half a century of data across every country and every asset class, and it's very clear. But I think as humans, we just it's hard to get around that. I think then there's professional reasons. Look, here in Europe where we live, most people get all their financial services through a bank. And look, if you walk into a UniCredit branch, you think UniCredit is going to sell you like a passive index fund that, like, they make no money on?
Probably not.
No, they're going to sell you one of their own funds. Same thing if you work at Canale or HSBC in the UK or Deutsche Bank. Deutsche Bank is going to sell you DBW fund. Here in Norway as well, there are lots of big banks and they dominate financial services. And the average normal person still invests in very expensive active funds. So it's beginning to change a bit here. And I think also, so that's just, the banks have an incentive. So there's like these industry structural reasons. On the institutional side, like the sovereign wealth funds, the big pension plans in Italy, in Spain, France, and the UK, the big insurance companies. Those are kind of the sophisticated people. These are people with like PhDs and MBAs in finance. They know the data. And even there, it's particularly hard. And I think some of that is, look, they invest far more passively. Like, I think there's a very clear sliding scale that almost like the more sophisticated and data-driven investor is, the more passive they are. But I think also even there, if you're a chief investment officer sitting at a large Italian pension plan, look, are you going to make a lot of money and improve your career prospects by saying, look, I'm redundant, you should just buy these 3-4 index funds and forget about it for the next 100 years? No. You're not going to say that. And like we have jobs that kind of thrive. We all want to add bells and whistles to our own profession. It's why finance and medicine and journalism, we use jargon in our own industries that in theory we say simplifies communication internally, but in reality it's kind of barriers to kind of entry that it's kind of, we add complexity to something that doesn't really need it. I just think like if you're a CIO or a pension fund trustee or the CEO of a big insurance company, it's just cooler and more interesting to have a sexy asset allocation with a bit of hedge funds, a bit of private equity, a bit of venture, maybe some racy emerging market debt in sub-Saharan Africa. And maybe you'll put 20-30% of your equity allocation in passive. But you still want to have this other stuff around it that kind of makes you seem sophisticated and interesting. Because otherwise, frankly, an idiot could do your job. Like I could do, a journalist could do your job. In reality, look, I'm not saying anyone should ever give me a job managing money, but yeah, it's, most of this stuff is difficult. It's like Warren Buffett often says, like, investing smartly is super easy but difficult. Like, it's like dieting. Like, everybody knows what you need to do. It's just really hard to do in practice, which is why I know a lot of big investors and they're really smart, interesting people. They work hard. But like my investing hero is this one dude who sits as like a North Dakota pension plan. And he's the only guy that manages the state's entire pension plan. I think he has a secretary. And his main job is whenever somebody on Wall Street calls him up and pitches it on something, he listens politely and says, no, thank you, and hangs up. Now, on one hand, you can say that is a really difficult job because, that's hard to say no. You don't get invited to like Aspen. You don't get invited to Davos. You don't go skiing. You don't get invited to the big, sexy kind of parties. But like, that is incredibly valuable. And I respect the crap out of that guy because like saying no and choosing simplicity over complexity is in practice very, very hard.
Yeah. As far as the idea of simplicity beats complexity is concerned, for at least the last 40 years, the typical portfolio was the 60% stocks, 40% bonds, especially in the US and all around the developed world. The 60-40 has become the benchmark of any asset allocation. Now, starting from 2022, a lot of people started to question the effectiveness of this portfolio in terms of actual diversification because of rising interest rates and rising correlations. Therefore, I started reading about ultimate diversifiers beyond stocks and bonds, like, for example, private markets for institutional investors or crypto for anyone else, etc. What's your idea about these diversifiers?
Well, just to deal with crypto first, because it's very easy. I think it's complete baloney and nobody should touch it. Look, you might as well invest in, anything of scarcity that you think might go up. Like, you are depending on somebody else being even stupider than you and putting money into it. There are legal terms for that. But, you know, frankly, like stamps, gold, I mean, there's tons of other stuff that you depend on the same thing. Crypto is just a new thing. I have very little time for it because, frankly, I think it attracts some of the most grifty, credulous, or exploitative people on the planet. I always joke that like the ultimate selling point of crypto is it helps me sort out who I respect and who I don't. So I have some prejudices in this series, you can probably tell. When it comes to other diversifiers, yes. I mean, this is like the old kind of Harry Markowitz modern portfolio theory that you add enough diversifiers, like diversification is the only free lunch. And the more uncorrelated or non-correlated streams of income you have, the better it is in the long run. And this as a general kind of common sense, it makes sense to not have all your eggs in one basket, right? In practice, of course, look, we live in the world, and there are times where everything goes up, and there are periods where everything goes down. So diversification is not magic either. It can't bail you out. Private markets, look, again, the only reason why that is uncorrelated or non-correlated is because of accounting rules. Like, that is it. There is nothing else. Like, private equity is equity. And if, like, the economic outlook sours and corporate earnings go down, but maybe that company is particularly well run by some private equity firm. But again, like most of the evidence, even from the buyout industry's own research, indicates that the average private equity firm does not add any value operationally. It's what they do is they leverage, it's like modest gearing in a fairly accounting favored vehicle. So look, yes, private capital in general, so that's private equity, private debt, infrastructure, real estate, all these other things, have a major role to play in many institutional portfolios. Like even the Norwegian Sovereign Wealth Fund, like I said, is pretty much a passive 70-30 fund, but it does have a slice in real estate, and it keeps kind of flirting with the idea of going into private equity. But in practice, look, like right now, for example, like the stock market had a very bad day yesterday. And it was very interesting. You can see all the private markets did nothing. Now, does that mean that the value of that stuff that didn't go down?
Yeah, they are not mark to market.
Yeah, exactly. It's a figment of accounting. So I think there are true non-correlated diversifiers that you can put in a portfolio. There are certain segments of the hedge fund world, like commodity trading advisors or trend following hedge funds, do not all of them. And again, like there are so many asterisks there. I mean, we could spend an hour just talking about this stuff, but like there are certain hedge funds that specialize in kind of protecting that downside when everything does go to crap, like that they should do well. They don't always, of course, but they should. I think like with the 60-40, look, it's an easy rule of thumb in the same way that like passive is a rule of thumb. And that doesn't mean that it's always right for everybody, but it does work pretty well. But obviously it depends on how old you are. Like if you're 80 years old, you should not be in the 60-40 allocation because you want your money to be safe and not be exposed to the vagaries of a Trump-driven stock market. And the same way, if you're 18, 19 and saving for your retirement, I mean, having any bonds there is kind of ludicrous. You should be more geared aggressively to sort of a higher risk, more volatile, but higher returning assets like equities or emerging market equity. So, look, I think the death of the 60-40 fund, that obituary has been written a million times. I've probably written 100 of them myself. I'm not joking. I've probably written, maybe not 100, but I've probably written at least 50 articles saying the 60-40 fund is dead and the 60-40 fund is back over my career at the FT. I think it's valuable because it can remind people that, you know, this stuff doesn't last forever. You know, you can lose money in bonds, as we saw in 22 and 23. And I think that's a valuable thing for people to remember. You know, at some point, people need to remember that they can lose a lot of money in stocks as well. But I still think, like, if you are a very large, sophisticated institutional investor, using some alternative assets to diversify can help a lot, even though I think it's mostly because of an accounting issue. But if you're an individual investor, then equities and bonds are kind of the mainstay and should remain so. And you should fight the siren call of private equity funds trying to sell their wares to ordinary investors. There's been a lot of talk about this in the United States. They call it the democratization of private equity. And it's a great marketing line for them wanting to sell their stuff to ordinary people who are not necessarily equipped to judge,
to understand
the quality of these things. Yeah. I mean, they do a bad enough job choosing mutual funds. The idea that like ordinary people like you and me can choose like private equity funds is like, I mean, institutional investors struggle with it. Yeah, I think it's ludicrous. It's dangerous. It's a dangerous marketing line gussied up in kind of democratization of private markets, and I hope it doesn't come to Europe.
Yeah. On March the 7th, you published an article only consisting in memes about the absurd tariffs flip-flop Trump has been making as accustomed to. What the hell is going on in your opinion? Are they all dumb, as the Wall Street Journal called this foolish trade war? Or is Trump onto something we are still not aware of?
No, I mean, I have no clue. The reality is, like, I think it's very useful that this mantra, like, nobody knows nothing. I don't think Trump knows anything. I think he's flip-flopping because he doesn't quite know, and he listens to the last person who was in the White House. Look, I don't cover politics, and yeah, even the people that cover politics don't seem to have a good handle on what's going on. I wrote that story just to kind of almost sum up how ludicrous the whole situation is. Like, we had Harris on and off 4 times, right? It's like a bad soap opera. It's almost kind of, if something's fundamentally unserious, maybe you should treat it fundamentally unseriously, rather than trying to pretend, like you say, like, is Trump really, is this like, what's the 4-dimensional chess he's playing? Well, no. I believe in Occam's razor. Like, the simplest answer is usually the correct one. And he's a guy who's quite old, that knows basically nothing about economics, who has some very hardwired thoughts about, like, foreigners taking advantage of the United States. Now, tariffs are amazing. And overlay that with him listening to whoever was in the Oval Office the most recently, and you have a recipe for a lot of flip-floppy uncertainty. So I'm almost certain tariffs will come, and they'll be bad. This is a very different Trump administration from the last one. The last time, he seemed a little bit overawed to begin with. He broke a lot of stuff, and he threw a lot of tantrums and made a lot of noise. But in reality, there are checks and balances there, both institutionally, legally, and from his own party. What I worry about now is that those checks and balances are not there anymore. So whether you like Trump or hate Trump, you're going to get more distilled, pure Trump this time around than we did in 2016, 2020.
In fact, we have had a taste in these first 2 months of his reign about it. And in the meantime, while the S&P 500 and the Nasdaq are falling apart, Europe is doing better as a stock market, at least for now. And I quote you about it: Europe is basically the Tottenham Hotspur of international economics, sometimes promising, occasionally embarrassing, ultimately disappointing, and unable to win any prizes since 2008. Is it this time any different?
That's the multi-trillion euro question now, right? I don't know. Nobody knows nothing. But I would say there is this sense that things have changed. I mean, arguably things should have changed a long time ago. You and I are old enough to remember kind of the Eurozone crisis, almost a decade ago now, right? And how scary that was, and how much talk there was of kind of Europe kind of needs to rediscover its dynamism, its kind of drive. And since then, nothing happened. Then, frankly, Ukraine was first invaded in 2014 by Russia. And Europe said, well, this won't stand. We have to change, and we have to be able to resist the Russia. And then, frankly, the first Trump administration came, and Europe was very good at talking a good game about, like, if if the Americans had elected a Trump once, they can do so again. We need to change. And then again, nothing happened. I think the massive geopolitical shock of what they're saying and doing this time around has forced Europe to kind of discover its backbone a little bit. What that leads to, I don't know. I mean, clearly there is more money going to be spent on defense over the next 10 years than there were in the preceding 10 years. But there's obviously lots of this, like there's a stock issue. Like it isn't like you can just turn a knob and suddenly like turn like, oh, we're going to spend like 1% of GDP to 2% of GDP and magically everything's fine. Like we need to rebuild like the investment stocks, the European defense industry and these things. So, but I think there is a lot of interesting structural, cultural changes going on. I mean, just the fact that, you know, we had the Mario Draghi report delivered to Europe last year about sort of a plan for European competitiveness. And a lot of in that plan is never going to happen. But a lot of it probably is, even though it's going to take far too long or longer than we'd like. And seeing, you know, Draghi and Christine Lagarde talk warmly about things like securitization, this financial technology that caused carnage in the financial crisis. You know, these are things that I would have said would be unthinkable in Europe just a few years ago. I think it's kind of the end of illusion in Europe. And I've certainly noticed it even here in Norway, where we are in NATO but outside the European Union, that like there's stuff that is happening on the political stage that I would never have considered possible in my lifetime. So maybe that's promising. Let's just hope that, you know, Europe does kind of shrug off its doldrums, because as an economy, Europe as a whole is as big as the United States. We've got a great population. We make lots of stuff, like actual, real, tangible stuff. We make it here. So, you know, Europe could do incredibly well if it just kind of maybe got us going, and then like that will then manifest itself in the stock market as well. But like, frankly, look, on these big macro levels, I care less about what the stock market that does than that Europe can, you know, plausibly defend itself.
I recently read an article on the Financial Times titled "Europe Should Thank Trump for the Wake-Up Call." Is maybe the right time for Europe to stand up and do something, like Mario Draghi said a couple of months ago?
Yeah. And we can see in the stock market flows, I'd say, look, first January, February, it was mostly like, it's like short covering and rebalancing. Like Europe was so cheap. I don't remember the end of 24. It was all the talk of American exceptionalism.
Absolutely.
And Europe just got so cheap. There's a bit of a bounce and then people cover shorts. But now...
Yeah, it was oversold.
Yeah, it was oversold, yeah. So it's one of those things that can happen. And frankly, Europe has had periods in the past where it has kind of bounced a little bit, or they even threatened to have a bit of a renaissance, and it's kind of fizzled. But right now, I'd say just towards the end of February and March, there was this sense of things are changing. Like, I've been reading lots of investment bank research. I've talked to analysts and fund managers, and they are engaging with Europe in a way that they haven't for a while, or certainly weren't for the last few years. And I think that is really promising. Right? Whether something comes of it, I don't know, because nobody knows nothing. But at least I'm more optimistic now about Europe than I was just a few months ago. And yes, we can thank Trump for that, arguably.
Let me conclude the interview with a stupid question that requires a serious answer. Because I read somewhere that you say that your surname is Harry Potter.
Yes.
So, you are a financial Albus Dumbledore today. Therefore, give us wise financial advice to navigate the markets with peace of mind now that you know who has come back and wants to bring chaos and disorder with his Avada Kedavra, also known as tariffs.
Look, I mean, it's very tempting to just kind of cut and run. So, oh my God, like the world is ending, like we're tiptoeing towards World War III, all that jazz. I mean, in reality, most things like this too shall pass.
Love it.
I guess like my favorite bit of investment advice, I can't remember where I saw it first, but have you seen the film Finding Nemo?
Yes, of course.
Yeah, so the fish Dory, you know, she has short-term memory problems. So she has this mantra that it turns out her parents taught her, so just keep swimming.
Yeah.
Just keep swimming, just keep swimming. And frankly, look, as investment advice, that is a great idea. Like, I think way too many people spend too much of their actual precious lives that they could spend with their parents, their children, with their hobbies, their loved ones, making something, watching a bad Netflix film. They should just do that rather than stress too much about their financial investments. If they have a broad, fairly well diversified group of fairly cheap index funds, they should just keep swimming and just ignore everything else going around them. So yeah, just keep swimming, I guess, is my only investment advice, is even though like all these sharks seem to be gathering around in the water around us.
I was sure it was going to be a fantastic interview. Robin, thank you so much for being here.
No, thanks for having me on, Ricardo. I really appreciate it. I love talking about this stuff.
Please, guys, keep reading Alphaville if you want more of Robin and his team, because it's a fantastic way to, and a very funny one, to get a clue about what's going on the markets. And Robin, thank you so much, and see you soon.
Fantastic. Bye.
And that's all, folks. I hope you enjoyed this episode, since many of you often ask for references to better understand what's happening in the world of finance. Well, Robin, Wigglesworth, and Alphaville are most definitely a one-stop shop. Robin, I know you'll be listening. Thank you so much for the chat and for making me smile before, during, and after the interview. That's something we all need a bit more of, especially in times like this. You'll find a link in the episode description to Trillions, his fantastic book on the rise of passive investing, as well as to Alphaville. The Financial Times will probably want you to subscribe, but just to be clear, this is not a sponsored mention and I won't earn a cent in commissions if you do. As always, I invite you to hit follow and turn on notification on Spotify, Apple Podcasts, or wherever you are listening. And if you want to support us, leave a 5-star review. It helps us keep creating content that reminds you that, in the end, even a little mentally impaired fish can teach us a lot about how to defeat powerful dark lords of evil. That's really it for this episode. I'll catch you again next Sunday with a new one dedicated to, well, who knows? We'll find out by living, or rather swimming, right here, as always, on The Bull, your personal finance podcast.